we are doing these monthly podcast webinar, different formats, which we started last month at LAQSA. So this is the second one, and it is my pleasure to introduce you to today's speaker, Anish Teli, who's a successful investor, rank holding chartered accountant, and an MBA from the Indian School of Business, Hyderabad. He has a rich experience in the Indian equity markets for over 20 years. He's currently the managing partner at QED Capital, which is a quant-based PMS firm, invests in listed Indian equities using factor-based approaches. He has held senior positions with private equity funds before that, managed by ICICI Ventures and Morgan Stanley Private Equity Asia as well, where collectively there was management of more than a few $1 billion. He was also a voting member of the investment committee at Morgan Stanley Private Equity Asia. So he comes with rich experience, initially on the private equity side, and for the last many years at his own firm, which is focused on factor-based quant approaches. He regularly does research and has developed various systematic investment strategies and has been using them successfully since 2012. Interestingly, he's one of the few people in the Indian institutional investing world who has also co-authored papers on factor investing. He has two papers on factor investing in India. One is called Long Factors, Not Short Change, Long Only Factor Portfolios in India. And the second is the Conservative Formula Evidence from India. So with that, today's topic is he'll be diving into factor performance in India across economic and market cycles. With that, I'll hand it over to Anish, and very excited to go through what kind of factor approaches and indications can be there, especially given the way the markets are and the way some of the cycles seem to have turned in the last 6 months. Hi, Anish. Great to have you here. All over to you. Thanks.
Hi, Rishi. Uh, I hope you guys can hear me all. Yeah.
Yes, we can hear
you. Great. Thanks. So yeah, so good. We've been thinking about this for a while now, having something to do with organizing the quant space and research space in India. It's a fairly recent and new and exciting and growing space. So it's great that Rishi and Pankaj and all have taken this initiative and started this, and they've had a very successful conference recently. And so it's a great, place to meet, talk, understand, share ideas and all of that. So with that, let me just kick off on the topic for today, which is factor performance across macroeconomic regimes. It sounds like a very complicated, long topic, but it's actually, fairly, we're going to do it in a fairly simple, easy to understand, practical way. Interestingly, the last time we did this was about 2.5, 3 years ago in 2022. Russia had just invaded Ukraine. There was, these supply chain disruptions due to COVID. Inflation was just about rearing its ugly head. And now that we're doing this in 2025, again, we are in a very, very, very different macroeconomic environment where President Trump is back, tariffs are being proposed and then taken back every few weeks. The Indian market seems to be, seems to have sort of taken a bit of a breather, so to speak, and the economy has been showing signs of sort of slowing down, which is all part of the cycle. It is nothing that we've not seen before, but the more important thing is, how do we look at factors and how do we look at our portfolios and how do we construct and get through these times. So the way I would do it is, we'll try and keep it interactive. If you have any questions, just feel free to type them in the chat box, or we will take either I'll try and answer them during the presentation, or we'll take them up, post my slideshow. We'll not take too much time on that, and we'll see how it goes from there. So with that, let me just try and share my screen and then go through the agenda for the day. Just one click. Yeah. So this is what we're trying to go through today. The factor premiums. One is the academic form of factors, which are mainly long short factors. Now, factors are anything that affect stock prices. Typically, they can be economic factors. They can be financial factors, fundamental factors. So economic factors would be, as we understand them, as to be growth, inflation, GDP growth, and things like that, consumer sentiment. Those can be observed. Now, factors that we understand in the financial world, like something like value or momentum or quality, which we will talk about, those factors cannot be directly observed. They have to be, the professors Fama and French and many other researchers came up with a way to sort of figure out a way how to observe the performance of these effects that are there on stock prices, and they came up with the concept of factor mimicking portfolios. And these are certain effects that are there on stock prices. It first started with the CAPM model, the capital asset pricing model, which said that market explains almost all of the returns of a stock. And then as we did more and more research, and they figured out in 92 that no, there are a couple of more things like value and size which also impact stock prices. And then later it was quality, uh, low volatility, and momentum. So over a period of time, as more and more research has gone into this, more factors have been discovered. But broadly, these are the 4 or 5 group of factors which have sort of stood the test of time in terms of, are they pervasive across asset classes? Are they implementable? Are they observable? And do they stand the test of time across many decades? And in the US, they have the uh, his luxury of having data for almost 100 years. In India now we at least have data for at least 20-25 years, which is fairly good. When I started off about a decade ago, we only had 15 years of data, 10 to 15 years of data. So and we've now also seen in real time some of these strategies working. A lot of people had a lot of doubt, whether these would be implementable, whether these are just fancy back tests, whether these will work or not. So these factors, strategies have worked, and that's the good thing. Now, long short, while it's a good construct in the academic form for practical investors, like most 90% of people would be implementing these factors in the long only form, rather, which is basically that buying a set of stocks which adhere to a certain factor, these uh, qualities, like say if it's value, then buying something cheap with something that's cheap on price to book or price to earnings or price to sales, or quality, which is something that is high on ROE, high on gross margins and things like that. Momentum, something that has done well in the last 6 to 9 months and is expected to do well in the next 3 to 6 months. So we've observed now a lot of these, portfolios in real time in India, and we've seen that these have performed well. We'll try and show you that, is there something lost? There are quite a few conversations around, do most of the factor returns come from the short side? So do you lose too much by doing only a long only portfolio, by implementing a long only portfolio? And I think we'll show you that you can earn a fair amount of premium even if you are implementing a long only portfolio. We'll go into some amount of Q&A if you guys have more questions. And so with that, let me just start off on this. Just a disclaimer that this is not investment advice. This is just for educational purposes only. And please consult an investment advisor before investing. Just to set the background for this, we came across an interesting paper uh, on this in 2017 by S&P, where they looked at 2 or 3 backgrounds on which you could assess factor performance. One was uh, business cycle. Another was another was market cycles, another was investor sentiment. Today, we are going to primarily look at business cycles. Now, business cycle, for that, the proxy that they took was the a composite leading indicator designed by the OECD, which typically looks at short-term fluctuations in macroeconomic factors and gives us some sort of hint about whether the economy is in a contraction or an expansion mode. And it's a very fairly simple definition of whether we are in an expansion mode or in a contraction mode. If the CLI indicator is in a rising trend, then it means that we are in an expansion mode. And if the CLI is falling, it means that we are in a contraction mode. And with that background, we mapped so the first chart that I'm going to show you shows the academic and which are the long short portfolios. And we started from 2006 onwards, and you will see that the green shaded portions are when the CLI is in an upward trend, so that it's increasing month on month. The red shaded portions are when the CLI is in a downward trend or it is reducing month on month. We've plotted the Nifty in that background, and then we've shown in those economic periods, which are the factors that have done well in those particular macroeconomic regimes. And as you go through, you'll see that there are certain factors that appear repetitively in the expansion phase, especially the market factor and the momentum factor. That those factors have done consistently well in expansion phases, and as well as the size factor. Size, which are typically tends to be small caps, high beta, very economical, very sensitive to the economy, typically tend to do pretty well during an expansion cycle. And as we've seen in the most recent expansion cycle, which ended in October and November of 2024, that size did fairly well. Again, these are you should remember, these are long short portfolios. We'll also show you the performance of the long only portfolios. Now, these factors also are in some ways compensation for bearing some amount of risk. There are two major reasons for which academics and practitioners accept for the fact that factors work. And one is a behavioral reason, the other is a risk premium reason. So behavioral is that that investors repeat certain behavioral patterns across cycles, and in behavioral finance, these could be the anchoring bias, the risk aversion bias, the lottery effect, and things like that. And some of these behaviors tend to be fairly repetitive, and they repeat themselves over cycle. Even though some investors are there across cycles, they tend to make the same mistakes over and over again. Or there are new investors entering the market and old ones exiting, and these new investors are sort of learning these new lessons every time. So for something like momentum, the behavioral reason is a far more accepted reason than the risk premium reason. Academics have still not been able to define in a very robust manner why momentum deserves a risk premium. So the reason for that is usually behavioral. But for something like value, which comes with a certain amount of risk, that you could be caught in a value trap, or these the stock prices are fairly volatile, the company performances are fairly volatile. So there is a reason for bearing some risk. There is a premium for bearing some risk for buying a value stock. Even for something like quality, that companies that move at a slow pace, companies that but have an economic moat, have high gross margins. Investors tend to systematically undervalue these kind of companies because they don't have high growth. So again, a good behavioral reason for why quality stocks also work over the long run. Now let me just show you some numbers in terms of these are again long short portfolios. So if you see that across periods in expansion cycles, the market factor, size factor, and the momentum factor typically have done the best in across the period that we studied from 2006 to 2025. We've not updated the numbers for this particular table for 2025, but we studied that and we see that it's not changed too much. Excuse me. And typically in a contraction, as you would expect that something defensive like quality, which we see in RMW, which is robust minus weak, the profitability factors. Again, momentum, which does well in expansion as well as in contraction, and low volatility, which again tends to do well in a contraction period. So most of these long short factors tend to have cycles in which they perform well. And the way to think about it is, when you're constructing your portfolio, is to have more of a multi-factor approach. Or if you have a view on certain cycles, or if you have a view on the economy, then you could sort of express that using single factors and do it in a more tactical fashion. So depending on your use of these this information, you could sort of implement it and express it in your portfolio. This would be of more interest to many practitioners like us, that these are long only factor premiums, and we've looked at how they have performed across cycles. Again, the same expansion and contraction cycles that we showed you for the long short portfolios. And you can see that again here you will see a similar pattern, that market momentum, size tend to do well in expansion periods. Value also tends to do well in certain periods, in an expansion period, because again it's economically sensitive. If the economy is rebounding back from a contraction, then these companies which have cyclical performance tends to do much better. Whereas in a downturn, quality companies, which typically comprise of FMCGs or consumer staples, healthcare, those kind of sectors tend to do are more robust and tend to do where demand is more robust and less inelastic. That tends to do much better in a downturn. And again, we would be seeing some of that behavior in the last 3 to 4 months since we've entered into a contraction. The CLI has actually started sort of falling since November this year, so November of 2024. One interesting thing that I want to just point out on this chart here is that if you see the contraction period between July 21 and May 23, you will see that value has done fairly well, which typically has not happened anytime in the past in a contraction period. And perhaps it's why this particular period post-COVID was very different from earlier macroeconomic regimes, in the fact that we were in a very strong QE cycle. Interest rates were low. There was massive stimulus post QE. There was massive rebound of demand, which was coming off post the lockdown, and there was a supply chain disruption. So that could be some of the reasons that we could explain why value has done quite well in both the expansion and the contraction cycles post COVID. The other the other interesting one which is missing post 2020 is quality. Now, quality as a factor has not done too well post 2020, and my thesis for that is that if you see from the crisis from 2008 to 2020, you will see that quality has been a top three in both expansion and contraction cycles. And one of the reasons was that, again, that we were in a zero interest rate world. There was a huge amount of risk aversion post 2008 to companies that had high amounts of debt. And then there was a narrative of moving towards quality companies. And what happened was the valuations of these quality companies got bid up quite a bit, and the valuations moved to very, very unsustainable uh, region. And some of these companies are still trading at fairly high valuation. And of course, we can't say until when certain patterns in the market persist, but we do know that at some point in time they will sort of break down. And so for that reason, I think from May 2020 to now that we are in the beginning of 2025, that quality has not done too well. And and we've seen in the last couple of years that some of these large quality companies in India, which tended to be in the paint sector or in FMCG or some of those, uh, are now seeing fair amount of contraction, not just in their profit margins, but also in their valuation. So maybe in the next cycle that this reset happens and quality sort of makes some kind of comeback. Again, this is not investment advice or anything of that sort, but just an observation from what we've seen over the last 5 years. And that's again a reminder for practitioners like us that factors do work over time. There is a factor premium to be harvested over time, but nothing works all the time. There is no silver bullet in factors that, if you're following a certain factor strategy, like say value or size or momentum, that it will work in, every kind of market. Although momentum, because of the fact that, it tends to um, some call it also the chameleon factor, because there is a certain amount of riding on to other factors. Like if something, let me give an example that today, and the rebalance of the momentum factor is also fairly more faster than the other factors. For example, value, the decay of the value signal is maybe happens over a period of 6 to 9 months, whereas momentum is something that decays in 3 months. So the portfolios tend to get rebalanced fairly quickly. And we've also seen that market cycles and sector rotations have become very, very fast in the last 8 to 10 years. So momentum, tends to do well, but it's also a very, very volatile factor and has high churn. Many investors don't like high churn strategies, and it's also a factor where not a lot of uh, fundamental information is factored into it, because we believe that price gives us a lot more information than what fundamental metrics would give us. And that's a belief that not many investors want to, are okay adapting it. It's one of the reasons also why, pharma French call it like the most that it's a blot on the face of the efficient market hypothesis, that something like momentum exists. But they also use momentum at dimensional fund advisors, where pharma and French are co-founders. And so momentum is something that cannot be ignored. Uh, even the valuation guru Ashwat Damodaran in many of his interviews has said that even hardcore blue-blooded value investors do tend to look at momentum, and they ignore it at their own peril. And even somebody as revered and somebody as successful as Warren Buffett also looks at, I wouldn't say he looks at momentum, but he does look at when things are slowing down in a company, or when things are not working out for him in terms of the stock price. For his one good example, there is IBM. He held on to it for a couple of years, and then he was quite okay getting out of it. And even as recently, he's had a very good ride in Apple, and he's been selling that down over the last 3 to 6 months. He's entered Japan about 3 to 4 years ago, and Japan has done fairly well in the last in the same period. So so these investors also tend to spot certain trends or certain movement in either in sectors or in companies, which then gets manifested as factors. Interestingly, there was a paper by AQR about 10 years ago called Buffett's Alpha, where they uh, analyzed his performance over the last 40 to 45 years, and they broke down his performance, and and one of the two most important factors that they found that his portfolio was exposed to was quality and low volatility, which is quality is something that he talks about in the sense of economic moats. And so, that was not a surprise that that quality explained a lot of his returns. But he he was not a factor investor in the strictest sense of the term, but every fundamental investor does end up implementing factors or using factors in some form or the other in their portfolio. So it's not something that one can ignore. Even now, uh, a lot of fundamental investors are incorporating factors in their process, maybe not directly, but as a risk management tool. They're using a lot of these risk models offered by Bloomberg and Refinitiv to at least look at their portfolios through a factor lens and see which factors they are most exposed to, or which factors they are looking, which have run up a lot, and should they sort of be cutting down some bets. So factor investing is a space in that sense that is growing in different ways, and is not just for systematic investors or quant investors like many of you would be here, but also for many fundamental investors who are finding out a way to incorporate it in their investing process. Again, so we looked at these long only factor premiums across cycles, and we took some certain proxies which were indexes by the exchanges, and most of these today in 2022, when we did the first webinar on this topic, not many momentum was there, quality was there, but today we have, I think, indexes and portfolios available on most of these uh, long only factor portfolios. So again, as you can see here, in the one thing that I pointed out, quality. If you see the quality column, you'll see that in the last from May 2020 onwards to October 2024, it has not figured in the top 3 factors at any point in time. It's only now in the last 4 months that you can see where we are very early into this contraction, so it's very early to say that quality is going to do better or something of that sort. But maybe momentum had a lot of value stocks, and that's one of the reasons why it's corrected the most, followed by size. Size always corrects, and that is something that one has to be very mindful of in contraction periods. For example, you can see that uh, size can be very volatile in contraction periods, and so you have to have some kind of edge in terms of timing it, or in terms of at least having a portfolio which is well diversified. So one of the ways to do it is also look at the correlations between the excess returns of these factors. And interestingly, what we found is that as has been backed by in academia, that momentum and value have the least amount of correlation over a period of time, which in some sort of intuitive way makes sense. value in some sense is a mean reverting kind of strategy, whereas momentum is a more of a trend following strategy. The fact that they would be negatively correlated or least correlated in a long only portfolio form also makes sense. But yeah, as you can see, that quality has not had a great time in the last contraction and expansion cycles. It's been momentum, it's been value which has done extremely well. Size has done extremely well. So now we are seeing that correction in small caps, we are seeing that correction in micro caps, and and we're seeing the outperformance of the large caps, as you can see, since October till February. And as you can see, even across the cycle, that so one of the things that we used to be that someone like Jack Bogle, who's a titan of the industry, has said for the know nothing investors, or has said for most, that 80-90% of investors should have the market index or a large broad based index fund as a core in their portfolio. I think he was not off the mark. There's a reason why he is considered one of the investing greats, even though he was talking about a very and has very successfully built large index investing, passive investing business. Is one of the reasons that the market factor does pretty well across economic cycles, and over the long run is able to do a fairly good job of delivering that equity risk premium to investors. So this was a slide just to show that the academic factors as well as the long only factors, which as practitioners we would be more interested in implementing. So we see that in out of the top three factors, there is a fair amount of overlap, or almost 2 out of 3 factors overlap in expansion phases. Momentum and size overlap in 2 out of 4 periods. The market factor is the top 3 performer in expansion in all 5 expansion periods that we've seen till date. Even the size factor is the top 3 performer in 4 out of the 5 expansion periods that we've seen till date in the long only portfolio side. But the more important part is that you don't lose a lot by not having the short side in your portfolio. There is a fair amount of premium to be harvested, even if you are doing it from the long only side. You can do it depending on your investing style. You can maybe do it through a single factor, but if you are going to hold it across many years and across many regimes, it's always better to have a multi-factor approach. Now, even there could be many different ways to implement that. You could be holding different sleeves of say value, quality, and size in different portfolios, or you could be having a multi-factor approach where you are combining all these 3 factors in a single combined portfolio. This again is the period for the overlaps for the contraction period, where again we see that in contraction periods low vol quality tends to appear most of the time, and even momentum, because it's a fast churning strategy or a fast churning factor. It's fairly consistent if you are again able to adapt to churn, or you're okay with the churn. Then even momentum tends to be a fairly good factor even during the contraction periods. Again, here we see that there is a higher correlation between the long short and the long only factors even in contraction periods. So this is a way to show that that research done in the academic world tends to also have a fair amount of implementation. It tends to have a fair amount of real life use in investing, and it has, and the good thing that we show, that we've also shown through our papers, is that whatever has worked in the US markets or in developed markets in Europe, in different countries, has also worked in very robust statistical tests in India also. So India is not very different from rest of the world. Like, it's not like these strategies are going to work only in developed markets or in US markets, but these strategies also work in Indian markets also. So summing up, I would say that for those of you who joined somewhere towards the end or in the middle, that there is a fair amount of overlap between the long short and the long only factors. Although the return differences would be there. So value, low volatility, quality, all these have positive returns, but remember these are long short portfolios, and the long only version of some of these factors would be negative, would be giving negative returns during this contraction period, but those you would tend to lose relatively less in those contraction periods. What we've also seen that there is a fair amount of overlap between quality and low volatility factors in these contraction periods. So, and we've also looked at different versions of these of quality and low volatility, different definitions, and we found that different definitions also survive the and when we do the regressions with the pharma French kind of factor data set, they tend to show that they work fairly well in real life implementation. The caution that I would say that that not all long only portfolios are same. There is while there is a fair amount of overlap or a fair amount of consistency in the way these portfolios are constructed. What I've also seen in my practical implementation and my discussions with many other practitioners, that people have different ways of implementing the same definition. For example, momentum, the most common way it is implemented in India is not the academic way, which is a simple last 12 minus 1 month return, rank on that and take the top 30 percentile and build a portfolio and then rebalance that every month. People tend to form fairly concentrated portfolios of 20 stocks, 25 stocks. And also the way they do it is that they take a risk adjusted form of momentum, which is momentum divided by standard deviation. They also tend to look at different look back periods of 6 months, 3 months. Sometimes people take an average of 3 plus 6 plus 9 plus, because they want to have a quicker signal. Of course, there are many trade-offs that one makes while making these adjustments. But these are things that you have to experiment and you have to implement for yourself. Even in terms of weightage, some people take equal weights, some people tend to take market cap weights, some people tend to take the factor tilt weights. Some people take rank or take weightages by inverse of standard deviation. So again, all these different kinds of implementations, would have different impacts across these macroeconomic cycles, because you cannot have the same you cannot have different definitions having the exact same impact, but broadly you would get a similar risk premium if you tend to hold it across these long cycles. Most contraction periods tend to be 8 to 10 months, 12 months, and most expansion periods tend to be longer. But again, as we've seen, the last expansion period lasted for maybe 15 months or so. And now we've gone into a contraction period again. Maybe, we're already 4 or 5 months into it. Maybe it's another 6 months as per what history has shown us. But who knows, what the future has in hold for us. So Maybe in the future, as we try and do more of these kind of sessions here, we'll try and talk about, how many factors should one keep, how to allocate between factors, what are the different, risk reward scenarios of factor portfolios. Today we've looked at, the macroeconomic, how different factors perform in different macroeconomic environments. But what we could also look at is how do these factors perform in market uptrends and downtrends, and also how do investor sentiment impact, and what is the impact of investor sentiment on these kind of factors, and how quickly do they change their trends or cycles if investor sentiment tends to change within these periods. So I think we're at around 6:45, I think about 45 minutes into this. So let me just see in the chat section if there are.
Yeah, I think, Anish, people have put in some questions in the chat box. If you can see them, you can answer as you wish. If you want me to read them out, let me know.
No, I can see them. So I can I'll try and answer them. So Venel has asked, yeah, how are the expansion and contraction periods defined by? So that's something we addressed, saying that so we've taken the composite leading indicator, which is an indicator designed by the OECD, and it's defined by the monthly movement. We take them on a monthly basis. The data is available publicly, and so it's very simple. The way we've defined it, the way S&P defined it, is that if that indicator is moving in an uptrend, say if it is 100 and it's gone to 100.5 in the next one, 100.6, 100.7, that's defined as an expansion phase, and it's going from 100.5 downwards to say 100 to 99.5. That's defined as a contraction. And yes, in the long short form, market would mean the broad benchmark minus the risk-free rate. Your understanding is fairly correct. Also, yes, correlations may not have any predictive ability for regime changes, but that is something that should be taken into account when you're making a multi-factor portfolio. Like I mentioned, that momentum and value tend to have a fairly low correlation. They have a negative correlation in long short, but in long only they will have some amount of positive correlation. But across factors, it's the least. Also, in a contraction period, low volatility and quality tends to have a fair amount of high correlation, because high quality companies also tend to be less volatile, although that's not been the case in the last contraction and expansion period because of various reasons like I explained in my talk. Okay, the next question is, how should factor rotations being done? Is there an optimal way? Yeah, so Saran, that's a very, very interesting question, and that's something that is one of my favorite questions also. And I've done some work on it. I continue to do some research on it. We found some ways of looking at factor rotation. So one of the ways to look at it is valuation spreads. The other way to look at it is just simple momentum. But there are papers also out there done by AQR. The most read one, or the most cited one, is factor momentum everywhere, and also that momentum tends to be there is a lot of debate whether momentum tends to be, is it a factor by itself, or is it a meta factor for other factors? But I think that's been fairly explained, that it is a different factor, but at the same time it can be also used as a meta factor. So that's something on that. But yeah, this is a question which I think where people can have an edge if you have a certain different perception to look at how factors will rotate, or if you have a different view on how the economic environment is shaping up. The regime, we explained that, we are looking at the business cycle, which is the monthly composite leading indicator that broadly decides, and we can only know that in hindsight. So um, there are benefits of even looking at it in hindsight, because looking at history, we can know that, how this may perform, or what should we be prepared for in the future. So there is some amount of benefit of studying that history also. So Rutvik is here. So Rutvik says, factor definition is in the long short explanation is in line with globally accepted factor definition. Yeah, this is our factor definition in the long short is mainly from InvestPar, which implements the Pharma French factor methodology. They've, Rajan has done like almost 20-25 papers on factors and many other papers. And he also maintains a data set on the lines of the Pharma French data set. So the Pharma French methodology, which is to look at the the various definitions for value, um, quality, low wall, which for size, which Pharma French take, and how they orthogonalize the data set to reduce multicollinearity. That's the factor definition that has been taken for the long short factors. Factor the timing strategies, as most theories based on a multi-factor approach. Yeah. So like I mentioned, there is a number of multi-factor papers and factor timing strategies that are available on SSRN. I will try and suggest some papers on that. AQR has written, like I mentioned, a few papers on that. The rebalance and reconstitution of frequency of factor indices in the passive space, 3 and 6 months. So that, if you look at our paper, which I've co-authored with Rajan, long factors not short change, we've shown you a table of, what is the decay for various factors. As would be intuitive, momentum tends to decay fairly quickly over a period of 3 to 4 months, and value tends to have a fairly long time to play out, quality somewhere in the middle. But AQR also has a different way of doing value, where they refresh their value portfolios every month, but they refresh the price, not the fundamentals. So that's a different way of and that's a faster way of doing it. So maybe there is some merit in doing something of that sort. I hope that answered the question. Neural network. So there is a lot of work going on. Unfortunately, that's above my pay grade. Machine learning, AI, neural networks. That's not something I've looked at in a lot of detail, but that is something that I intend to look at. Will look at in the near future. The next question is, how does one control unintended exposures in momentum capturing growth or tech sector bias? So that sort of I mentioned that you can look at risk models. There may various risk models available today, or you can even construct your own. There may a lot of literature available on that from BARA, from MSCI, Axioma, now called SimCorp. And even a simple decomposition of your portfolio will tell you, a simple regression analysis will tell you what your portfolio is exposed most towards, which sector is it exposed most to, and if you want, you can, if you're not comfortable with that, then you can have certain ranges in which you can keep your portfolio and keep rebalancing that portfolio to your desired target weights for either factor exposures or for sector exposures. Of course, there will be trade-offs, because um, um, if we had put in biases, say in our momentum portfolio in the last 2 or 3 years, when public sector enterprises did extremely well, and they had not done well for the past decade, then one would have missed out on a very, very long, very big return stream there. So there are certain trade-offs, and that's something that You as an investor can decide what risk you want to take for what reward you want to harvest. So the next question is on however historical combination of factor combinations like value, momentum, quality evolved across different market cycles. So, uh, again, not to plug but there's a paper we've written on the conservative formula where we combine the value, momentum, and the low wall factors, and we've looked at how they have performed across different market cycles. I think it's from, we might be updating that paper again, maybe this year, by the end of this year. But even there, you will get a fair amount of idea of, how they have performed across cycles and which sectors were these multi-factor portfolios exposed to the most. For a retail investor, there are many ways. There are many DIY kind of portfolio tools available today. There are screeners available. There are ways to automate some of these strategies with by integrating them with your, if your broker offers it. So I think those would be the uh, best starting points for that. Does it make sense to use sector neutrality as a practitioner? It would be slightly tough, but yeah, why not? If you have a certain view, um, then it does. Then you can use sector neutrality to do that. Is there something better than more relevant than CLI for defining macro regimes? Yes, of course, you can use a combination. So, but of course, CLI is a combination of many macroeconomic factors, of many macroeconomic variables. But if one large macroeconomic variable is GDP growth, is inflation, is interest rates, so even if one can come up with a different model using some different weightages of these these large variables which impact, if not markets, at least market sentiments to a very large extent. Even those could be used to define different macro regimes. Interestingly, there are different papers on whether do interest rates have an impact on the value factor. It's been found that that is not the case, but on SSRN you could look up on some of these papers that is value and interest rate bet, or is is quality something different, is a bet on something else. So yeah, so I think one could look at that also.
Great. I think uh, if there aren't any more questions, I will just wrap this up. Firstly, before people start signing off, one thing that I had wanted to share was that, as I've discussed with some of you also in the last few months, that we are already seeing various subgroups form within LAQSA where, there are many members and potential participants who are interested in, let's say, only factor-based approaches on the quant side. There are some who are interested only in, systematic technical trading kind of approaches. There are some who are interested only in the theoretical math, stats, quant kind of stuff. So there are various subgroups like this forming wherever there are, enough participants, enough interest. The goal was to have, properly defined subgroups where the participants who want to be there, they can be a separate group for that, separate WhatsApp chat, etc., etc. And regular meetups and maybe presentations from different people keep happening. And with this today's session, just wanted to share that Anish will be leading the factor subgroup at LAQSA. So, we'll hear much more from him, and he'll help me and Pankaj coordinate the various subgroup meetups on the factor approaches. And hopefully, as we go along, that may lead to some interesting new research that all of us also do as a group at LAQSA. So really looking forward to that, and thanks to Anish for today's session as well as agreeing to lead that subgroup, because I think it can be very exciting for all of us, at this infant stage of the quant market development in India. And of course, all of you who have been present here, I'm assuming that most of you would be interested in that. So please email us separately asking to be part of that subgroup, and pass on this information to all your friends and other members that you know, so that we can get that group going regularly post today's session. Thanks, everyone. Thanks, Anish. It was very
Thanks, Ritesh.
informative. In a simple manner, you managed to explain the various expansion, contraction, and performance of various factors. Some new inputs even for me. So very, very interesting. Thanks.
Thanks, Rishi. And I look forward to hearing more from, all of you guys. Just send in your suggestions, send us what you would want to hear about. We've got a fair amount of idea from the questions that you guys sent in. So, we'll try and tailor some of the later events around some of those topics, and hopefully we'll all of us will have a, good learning experience from here on.
Perfect. Thanks. Signing off.
Thanks. Bye.